Yeah.
Oh, the other way around. Oh, yeah.
Yeah, good afternoon, everyone. So today we have the pleasure to talk about the investor perspective in climate. But before we get started, I think it's a good idea to just get a brief introduction from each of you, so you can talk a little bit about your fund scope and where you're actually coming from when it comes to climate tech. Beau, maybe do you want to go ahead?
Start? Hi, everyone. My name is Beau-Anne. I'm partner at Forward.one. We're a Dutch-based deep tech hardware fund. Climate tech is one of our main pillars. We also look at semicon, quantum, and Industry 4.0. We're a seed Series A investor investing across Europe.
Amazing, thank you.
And hi everyone, my name is Duncan. I'm general partner at a fund called SOSV. We're a global deep tech fund. Within SOSV, there's two pillars. One is on life sciences side, that's called IndieBio, and then another on the physical sciences, that's HACS, that's what I run. So that's hardware and chemistry. We're 70% into climate, 15% non-climate industrial. Some people call it climate, I don't. And then 15% into healthcare. And most of what I focus on there is actually mental health. We're pre-seed investors. We have facilities, labs, like chem labs, electronics labs, engineering departments and engineers that help bring the technologies that we're investing into life. So we're investing very early stage into scientists that have like a lab top kind of benchtop technology, and we're just helping them to engineer that into a physical product that can withstand industrial pressures.
Okay, so Duncan, you mentioned you're a pre-seed investor. So usually you're the first investor at a startup, and there's quite often a lot of talk about founder market fit. What specific traits or experiences are you looking for in climate tech founders?
Yeah, so I mean, because we're investing so early, it's all about the founders. I mean, like you can use technology to kind of gauge how good the founder is in many ways, but really it's about investing in the right founders. And those founders are typically founders that have been working for a long time in a research institution or as a postdoctoral research project on a particular technology that we think is going to be impactful. We go out to search different universities and different research institutions for interesting technologies as a kind of a funnel into finding the people that we believe are going to make a difference. And generally, you know, those people are, I say this often and it kind of gets misinterpreted, but I'm going to say it again, unhinged. They have a sort of I mean, because doing a hardware startup, particularly in climate tech, is incredibly hard. And so they have this kind of perception of the world that it's completely wrong and it needs to be fixed with this one thing that they're going to take into the world. And they will not stop at anything to get that, to make the impact that it needs to. And when we find people like that, it's very easy to deal with them because they're like, yes, I'll move my family to wherever I need to go to do this. Yes, I'll come and I'll go to India to work with your engineers, or go to China to work with your engineers, or come to New York to work with your engineers. Whatever it is they need to do, they'll just go ahead and do it. And whatever barrier they have against them later on will seem insignificant in what they've done in the past.
Very interesting. Beau, when you invest, usually there's already a bit more traction. Maybe the technology has advanced a little bit more. But still, how do you assess founders and what specifically are you looking for?
Yeah, so I think one of the, well, I would say, issues that we bump into quite often is that you have this great team of founders. But being in the deep tech hardware space quite often means they're all very technical and they're very passionate. I totally recognize what you say about their product, and that's great. But at a certain point, as a company, of course, you need to commercialize, and that's quite often where you see that these teams develop in the wrong way, because the moment where they need product market fit, they decide, okay, we'll hire a sales manager. But if you let 3 or 4 technical people hire a sales manager, you get another technical person. And you know, you need diversity in every team. So I think diversity, not only in backgrounds, but mainly in kind of personalities and capabilities, is very much important. And we actually work quite actively with, we have a number of venture partners who have a sales background, who have worked in sales their entire life. And that can actually help in recruiting good salespeople for these teams, or commercial directors or CCOs. because I think as a startup or as a team, you need to think about selling your product not when it's finished, but already earlier on. Because I think that's also something that we've noticed. A lot of technical teams quite often believe that if you have an awesome product, it will sell itself. But an awesome product is not always what the customer is looking for.
Interesting. I mean, it makes sense. You're investing a bit later, so you highlight the commercial part a bit more. It's more important for you. Duncan, would you still look into that at pre-seed stage, or do you think that's something that startups can figure out along the way?
No, of course, no. I mean, yeah, just investing in technology is a terrible business model for a venture capitalist. There needs to be a clear path to an identified market. A lot of the time, particularly coming out of some of the US research, they've already got very clear understanding of some of the problems in industry that they're addressing with a particular technology. And, due to the fact that we've then got our tentacles into a variety of different industries already, will then help to get more insight from that industry. And so to understand, really validate, is this technology actually going to be able to scale in that one particular marketplace? And then, as Beau says, it then becomes about how do you create a team around those technical founders who are actually capable of executing on that opportunity. And that often is one of the really hard parts.
Do you maybe have an example from your portfolio where they had a very technical solution at the beginning where you were skeptical whether they would find the right commercialization path, but they ended up doing it anyways? Okay,
so I've invested in 250 companies. So yeah, there are a few.
Okay,
so I'll think about a recent one.
Yeah.
So there was a company out of Princeton, actually. So it was a professor and a postdoc. The company is called Purely, and they have a technology for accelerating lithium extraction from the pools in the Atacama Desert. And initially, we were concerned that is this team too academic? I mean, are they able to actually get to accelerated trials? And what we realized pretty quickly with them was that they were, again, just so determined to get out into the field. They got out, they did a trial immediately, was very successful, and then started to find that through kind of spreading the word with those customers, all of their competitors and others started to kind of get on board and start getting excited about the technology. And that one has been just accelerated so fast into the market. It surprised me. We did the investment a year and a half ago, and they're already looking to do a Series A.
I think another aspect that's quite interesting about the climate space is the dependency on regulation. And we've seen in the EU, for example, quite often that regulation can either create markets or can destroy them. Especially, I mean, I'm from Germany. The German car industry at the moment is quite heavily affected by that. Beau, how do you factor that regulatory risk in when making investment decisions? And has it ever been a deal breaker for you when looking at a startup?
That's a very good question. So, yes, we take it into account. In the sense that we want business models to work without regulation, because being completely dependent on regulation can be a very great add-on, and it can really accelerate businesses. But betting on that, it's just something that you cannot influence as an investor, but also not as a startup, well, to a certain extent. We have one example of a portfolio company. They're called Nuventura. They're Berlin-based, and they make SF6-free switchgear. And for those of you who are not familiar, F-gases are very hazardous for the environment, and they're banned from all products except for switchgear, where they're used for thermal isolation, because until recently, there wasn't a good alternative. And so this company was brave enough to decide to start working on an SF6-free switchgear, even though that all the other operators in the field are big names. And there was no regulation, but we did invest because we felt, also in terms of maintenance, not having SF6 has benefits, right? And also from a cost perspective. But what you do see is that because they got this product certified and type tested, the EU then started thinking about regulation, because suddenly they had an example of, a switchgear without this hazardous gas. So after we invested, regulation actually kicked in, and now you do see that that does tremendous things for their sales. So it can really help a startup, but I think it's very important to invest in stuff that also works without regulation, simply because there's very limited influence that you can have on such things.
Mm-hmm.
I think regulations, though, can swing both ways. It's sometimes also a positive for the companies.
Mm-hmm. Yeah.
For example, in the US, where we do a lot of our investments, you look at the EV landscape, there's just increasing regulation on anything imported from China. And that means that anyone that's creating something, like you're creating batteries, you're doing battery recycling, you're able to get rare earth elements or other critical minerals that are US sourced, US molecule, those regulations start to act in your favor, and you don't need to think so much more about like green premiums as more like this is energy security. And that is a huge benefit for a lot of the investments that we're starting to make as, not us, but as the whole community of climate tech investors, is in how you create this kind of supply chain within your own borders that then starts to create these huge economic benefits for both the customer and the startup. Mm.
Yeah, I think a good example for that is also the new CBAM regulation that we see in the EU. I think there have been like 5 to 10 startups maybe founded in that space that are just trying to help companies guide through that CBAM regulation. But of course, that wouldn't be relevant for you because it's more on the software side and doesn't fit to the deep tech angle that we're having here. Let's switch gears. Let's talk a little bit about greenwashing. Duncan, you're from the US, so you must have been aware about the craze around e-scooters, for example, a few years ago. Yeah. We've seen the ups and downs, but I remember when there was all this hype, for example, around the e-scooters a few years ago, that some investors were quite proudly claiming how amazing this will be for environment because people don't need their cars anymore. But in the end, I think when you looked at it really holistically and across the whole life cycle, it turned out that all these e-scooters are not necessarily better for the environment when you look at, for example, just the batteries. But how do you factor that in, and how do you making sure that you're not falling into the trap of greenwashing when investing in a company?
Yeah, so I mean, an even worse example of that is what happened in China with the bikes. Some were electrified, some are not. Yeah. And there was it was I think good intent to start with. This idea of micromobility makes a whole load of sense. But when you start to decrease the cost of things to a point at which it's basically being funded by sovereign wealth funds. Your transport is being funded by sovereign wealth funds, and you're creating so many bicycles or so many scooters into one space. You have to just stop and think, hang on a minute. Am I actually just creating a whole load of waste that was not even necessary in the first place? And you can see that across multiple industries. That's just one example in the mobility sector. But if you think about, you could fall into the same trap with manufacturing if you're not careful. You could create optimized supply chains, which is something that we try and do a lot. We try and reduce the Scope 3 emissions and the overall waste within manufacturing. You've got to be very careful to make sure that you're still creating, let's say, a pair of jeans that are going to be worn for a long time, not ones that are great and that fit once, but then you throw them away straight away, even though you've like optimized the hell out of the supply chain to get them there. So that's something I think is something that investors need to just constantly bear in mind to make sure that they're philosophically aligned with the reality of the investment they make. Mm.
Can I respond to that? So
yeah.
I partially agree. So I think waste is something that we should all try to avoid. Mm. And also as investors, you have a responsibility. We all have a responsibility, right? To make sure that does not happen in your supply chain, or that your money is not used to create such amounts of waste. But I wrote an article a few months ago called My Unpopular Opinion About Impact Measurement, because I feel that we've completely lost track of what's important. I think what's important is that we're all investing like ethically and in a sustainable manner. But this constant need for us to impact measurement everything is going completely beyond its purpose. So if you take, for example, electric scooters, yes, the waste is not good. The supply chain might not be optimized if you compare it to diesel scooters, which had plenty of decades to be optimized. But at the same time, if you, well, I'm from Amsterdam, and if you walk around Amsterdam, there are no scooter. Every scooter is electric, and that's such a better, environment to live in than compared to a decade ago. So my whole point is, I think sometimes, of course, you have a responsibility as an investor, but we should not neglect the impact of innovation itself. It takes time to change an industry, it takes time to change a supply chain, but innovation in its sense and electrification is a good thing.
Interesting. I'm from Berlin, so in Berlin people hate e-scooters. I can tell you that. And I think the main argument against e-scooters was that if it prevents people from driving their cars, for sure, then it's good. But mostly it prevented people from taking public transport, which was then harmful. But I mean, I think this also shows a bit the complexity that we're dealing with, and I'm with you there in that regard, that it can sometimes be impossible to just perfectly model out everything, and sometimes people can also lose themselves in trying to do that. In the end, we remain investors and will be measured by our success. So it's all about DPI and TVPI. We need to show the return to our investors. But climate is hard because it takes a long time. So how do you deal with that, and how do you reconcile long times to exit, but also, in the end, making money?
Do you mean in hardware, investing in hardware?
Yeah.
So I think if you compare hardware to software, it is a little bit of a misconception that hardware comes with lower returns. I think what is proven is
longer time to returns.
Yeah, longer.
Yeah, that was my,
yeah. I think the capital intensity is, of course, a bit, steeper. So you have more capex investments in the beginning. But I think in the end, hardware investments can return just as good as software companies.
No, you're totally right in that regard. I mean, the most valuable companies in the world, I mean, it was at least for quite some time Apple, I'm not sure who it is at the moment, or Nvidia. So you're right. In terms of absolute returns, the hardware companies quite often outperform the rest. But when it comes to speed, do you have that same perspective? Because as you said, I mean, as a software company, you can easily get to scale in a short period of time, but hardware, it needs all that upfront investment when you can really get there. Or do you think you can still see the exits then within 5 to 8 years?
Well, I think 5 to 8 years might be challenging, and I think software has the advantage that, of course, you might be able to create an ARR early on, partially also funding your own company. But overall, I feel that, and this is going to be a harsh claim to make, but I feel that hardware companies quite often have a technology that is way more difficult to duplicate, and therefore the worth in terms of exits might be higher.
Yeah.
So I think as an investor, I wouldn't shy away from hardware. I think in the end it can be just as interesting as software companies.
Yeah. Duncan, what's your exit strategy?
Oh, wow. Okay. Let's back up. So, software versus hardware. I mean, I've been investing in hardware for 10 years, which is just a ridiculously long time to be doing that. And, trust me, it's got much, much better over the last 5 years than it did in the first 5 years. It's incredible just to see the amount of new investors coming into the space, experienced investors moving over from software to hardware. Comparing software to hardware, though, is not comparing apples to apples. They're completely different sectors. Software is not going to decrease the amount of carbon emissions that we have like hardware will. There's some optimization you can do, but ultimately, if you're really going to take molecules out of the air, or if you're going to prevent them from going into the air, you're going to rely on hardware. And if we think as investors about, what is the industry going to look like in the next 10 to 15 years, decarbonization is going to be probably the biggest theme in there, along with some national security stuff, but decarbonization is going to be the biggest thing. So we have to invest in hardware. We don't have a choice. And the people that are investing in hardware now, and that are continuing to invest in hardware over the next 5 years, and chemistry over the next 5-10 years, are going to be the ones that are going to be creating the massive returns. That's, the most amount of money that is going to be created over the next 20 years are companies that are still probably at a seed stage or a Series A stage right now, and they're reinventing the biggest industries that we have. Energy. It's enormous. Then we've got agriculture. We've got built environment. We've got transport. Those are all reinvented with hardware. So, you know, what's my exit strategy? I don't know. Supply the best possible companies that we can with the best technology into that area, create a whole load of value, and then we'll find ways to extract that value. Now, some of that will be with secondaries. Sure, we can take secondaries on larger fundraisers. Some of that will come with us being patient with the capital and returning back to our LPs. Any LP investing into this knows that there's a certain amount of unknown, much as there was with cloud compute investments. No one had done that before that happened, and then the people that did that made a whole load of money. So yeah, that's my investment strategy.
My colleague the other day said, well, M&A is not a strategy, building great companies is.
Right.
I think that's the whole point, right?
Yeah, but we will see a bunch of M&A happen, I think. Like, if you look at the energy, a lot of the energy companies, they're in a great position at the moment. They're making a crap ton of money with energy prices, but they know that they're going to have to start taking technologies that are proven in. What's the best way to do that? They'll go and acquire some of the really exciting technologies, take them in. That will be exits for the investors.
Yeah. And maybe let's end on that note. What's one technological innovation that you're most excited about?
Crap. Just one?
Or two. Or
okay,
three.
so I guess I think about what would get us out of this mess that we're in. I mean, obviously fusion is the one that would get us out of this mess, but it's very hard to make bets in that space at the moment. Geologic hydrogen is super interesting. If that does end up being as plentiful as it seems like it could be, that's a very interesting space, and that starts to create then a whole hydrogen economy where you look at transport and storage and new use cases for hydrogen. So that is fascinating. Personally, the one that I look at and that I'm investing in heavily at the moment is maritime decarbonization. And that's not like a big impact it's not going to save the world, but infrastructurally, it's such an interesting place to invest into because, 90% of the VC dollars into transport over the past 10 years have gone into aviation and automobiles. Yeah, and it's roughly 50-50, a little bit more into automobiles. Aviation is probably about 40%. But the GHGs from maritime is 50% more than aviation. You've got 3 huge groups of customers there, all just waiting to then suddenly need to decarbonize their sector. And so for me, that's kind of like and excuse the hideous pun, but a blue ocean opportunity where there's just, it was terrible, wasn't it? I'm a dad, I'm allowed to. And you can get these interesting investment areas where I think a whole load of capital will start to come in soon.
Yeah. Paul?
Well, Duncan kind of convinced me on the maritime sector, so
good.
We should
My
do
job here is done.
And I think to the first 2 examples that you mentioned, it's quite interesting, right? Because they're from a VC perspective not that interesting, and I think that's always the irritating part is that the most great technological advancements often take longer than the investment cycles of a VC fund. But something I'm very interested in, and currently you see kind of solar panel prices are lowest ever, but for the first time now also battery prices are coming down super steep. And that means suddenly it gets realistic to electrify a lot of things that earlier on weren't possible. For example, like high temperature industrial processes. So I think especially that's one area that I'm currently looking into.
Amazing. Thank you so much. We have a few minutes left and we'll open it for questions from the audience. What would you like to know from the investors? Yeah, there you go.
Hi, and thanks so much. Super interesting. So I'm curious to hear more about overall perspective on this question of complexity and navigating complexity.
Shall I go first?
Yeah, you go first. If you've got,
Yeah, sure. So, and by that I think you mean like very capital-intensive, long-term technological advancements to.
Yeah, just like overall. And
Yeah.
referring to the perspective that you brought out about, more focus on the metrics. I work in the narrative international relations space, and just looking at the background, I'm at what's happening in China, and then also what's happening here in Europe, and I have a narrative, a political economy perspective, and just see this need complexity, complexity navigation. Just this, I guess, really old discussion culture overall.
Do you want me to take that one?
Discussing
Sorry?
Yeah, I think I know what you're talking about here. So essentially,
Yeah, please.
yeah. So we're, I think, talking about geopolitical tensions. Is that correct? Within climate tech?
Well, also just overall in investment, we think the complexity also with intertwining crises that we have globally. Just, I guess, because these are wicked problems.
Yeah.
And we often need, I view, angle perspective, information. So just, I guess.
Yeah.
Well, we might be able to answer your question maybe from like a US and European perspective.
Right.
So basically, if I'll try to go first, and if I interpreted your question correctly, I think in Europe at the moment we're losing the game, right? So there's way too little money flowing into innovation. We do not have money for Series B, for Series C. We're completely dependent for growth equity on the US. Our landscape is pretty scattered, especially when it comes to policies. And at the same time, geopolitical tensions are rising. So for some crucial technologies, we're no longer allowed external investors from Asia, for example. So it touches our day-to-day work. It's something high on our agenda. And I think as a VC community, as a startup community, we need to raise our voices in terms to the European Union, saying that we need more capital like AIF, AIC flowing into the space. But maybe Duncan sees it differently because you're from the US and you're winning.
So I'm British,
Okay.
but yes, I am seen as US. My kids have a US accent. I work for a US fund. I live in the US. So I spent 15 years in China, and I only moved to the US 2 years ago. And up until 5 years ago, we relied on China to do everything in the manufacturing sphere, and now suddenly things have completely fallen apart. So we've got this really weird situation where the US is kind of ahead in policy. Like they've got very aggressive financial commitments to greenifying the economy, to rebuilding infrastructure. But at the same time, they're also, to the complexity part, they're also fighting inflation. And they are no longer allowed to use China to do all of this stuff. So you've got this sort of term that economists use called greenflation, which I just love. It's like this fact that you're trying to greenify the economy and fight inflation. You end up with greenflation, which is just worse than inflation because it's policy driven. And so the way that we look at that and try and kind of see opportunities is just to invest in automation that enables a lower cost of labor force for greenifying the economy. So that can mean a robot that goes down a gas pipeline which coats it so that it can carry hydrogen. So you no longer need to put a hydrogen pipe in. That's an investment we have. Or another one, a robot that can rewire a car so you don't need to have manual labor doing that. And that's kind of how we've kind of looked at some of these complexity issues as they relate to the overall economy. Does that answer the question? Okay.
Great. Well, thank you so much, Beau and Duncan. We're over time now. So, yeah.
Thanks a lot.
Thanks.